I'm Vikram Iyer and welcome to another CFA Nugget session. And in today's session, we'll focus on deferred taxes from level 1. Deferred tax is a highly misunderstood topic and you're going to get some pretty simple questions from there. And the best way to explain deferred taxes would be with an example. Let's take a look at a company. And every company is going to provide two statements. One is to the tax authorities and the other is to the shareholders. To the tax authorities, they're going to provide a statement which is as gloomy as possible so that they pay less taxes. And to the shareholders, let's say they're going to provide a statement that's as glossy as possible. So you're going to see some differences in reporting, and that's what leads to a deferred tax. So with an example, let's say a management has purchased a machine for $10,000 and its useful life is for 4 years. From a shareholder's perspective, the depreciation could be a straight line method. So each year, the depreciation is going to be 2,500, 2,500, 2,500 and 2,500. And from the tax authority's perspective, the depreciation could be 4,000, 3,000, 2,000 and 1,000. So you got the same total of depreciation, but it's attributed differently. What happens in year 1 and year 2? From the tax authority's perspective, in year 1 and year 2, the expenses relatively are higher. So you end up having a lower profit before tax, for which you pay less tax now. And what happens in the later years? There's a reversal. So in year 3 and year 4, the expenses from the tax authority's perspective are relatively lower and profit before tax is shown to be higher, which means you pay more tax in the future. And that's a classic case of a deferred tax liability. When you pay less tax now, only to pay more in the future, that's a deferred tax liability. And if we need to know deferred tax asset, it's going to be the other way around. When you pay more tax now, only to pay less in the future, that's a deferred tax asset. Hope this helps.